Hi, I'm Jeff Colton. In this unit, we're talking about the way that transactions impact on the financial statements under an accrual accounting system. One of the main transactions that companies undertake is providing goods or services to customers. That's the reason they're in business. Recognizing revenue from these transactions is obviously a key accounting issue. We've talked about the fact that the financial reporting rules for our large public companies and other organisations are based on what we call accrual accounting. This differs from cash accounting, which simply records when cash comes into the business or goes out of the business. Revenue recognition is important. It underpins and affects many crucial business and control processes, including budgeting, compensation systems, IT systems, and data controls, key performance indicators, and investing metrics. A new accounting standard governing revenue recognition was introduced for financial periods ending from 2018 onwards. The basis for the new standard is a 5-step model. This requires companies to consider whether a contract exists, an explicit and implicit promises in the contract to deliver goods or services to a customer, the transaction price payable by the customer, how to allocate the transaction price to the goods and services, and when to recognise revenue based on when control over the good or service transfers to a customer. The concept of control replaces the previous requirements to consider when the risks and rewards pass to the customer as the trigger point to recognise revenue. There's plenty of resources on the internet that will give you further details on this, and I've put some of those on the Moodle page. When thinking about revenue recognition under an accrual accounting system, the key is to remember that receipt of cash is not required for revenue to be recognised in the income statement. Revenue can be recognised at the time of receiving cash, but it can also be recognised prior to receiving the cash or even after receiving the cash. I mentioned in our first video that Qantas, Australia's largest airline, makes most of its money by flying passengers. If you think about how you buy a plane ticket, you typically have to pay the money well before your flight. Under accrual accounting, Qantas is not able to recognise revenue when you pay for the ticket in advance. They can only recognise the revenue when they actually fly the passenger. For a company like Woolworths, a lot of its revenue comes from customers buying their groceries in the store. In this case, revenue is recognised at the point of the transaction in store. However, some of the sales are wholesale transactions with other business customers. It's typical for these transactions to be made on credit. That is, the customer has to pay within a set period, say 30 days, in which case cash is received after the revenue is recognised. Let's think about the impact of these and other transactions on the accounting equation. So how would Qantas treat the money that it receives when we pay for a ticket in advance? Well, Qantas has received cash, so an asset goes up. Qantas is under an obligation to fly us in the future, so this obligation would appear as a liability in Qantas's balance sheet, called unearned revenue. So an asset goes up and a liability goes up. When Qantas flies us, the liability no longer exists, so it goes down. Qantas is now entitled to recognise the revenue from our flight, so revenue goes up, which means equity goes up. The same thing applies to expenses. They might be recognised before paying cash, at the same time as paying cash, or after paying cash. Qantas might pay for a year's worth of insurance for a plane. When that happens, Qantas records an asset, prepaid insurance or something like that, and an asset goes down, that's the cash. Over the year, Qantas will get the benefit of the insurance coverage, so the asset goes down. This is matched by recognising the insurance expense, which makes equity go down. Remember, increases in expenses reduce income, which reduces equity. Other accrual adjustments take place at the end of the financial period, let's say the financial year. Here's an example of an accrued expense. Woolworths might pay its employees each fortnight, but payday does not always occur on the financial year end date. So Woolworths employees will have worked for a few days up to the end of the financial year and had not been paid. When Woolworths is preparing its financial statements, it will account for this by increasing liabilities, that is, the amount that it owes its employees at the end of the financial year, and will pay them at the next payday. They also recognise the wages expense in the days up to the end of the financial year. That means expenses goes up and equity goes down. We can also have accrued revenue. Recently, Woolworths has moved into selling mobile phone plans. Let's assume that a customer is on a postpaid plan where they pay $50 at the end, on the 15th of each month. If at the end of the financial year is, say, 30th of June, then Woolworths will have earned half a month's of revenue even though payment hasn't been received. So revenue goes up and therefore equity goes up. The customer is going to pay on the 15th of July, so Woolworths will record an increase in assets. That's accounts receivable. I know this can sound a bit complicated at first. Have a look at the readings and at the activities. The best thing to do to try and get on top of this is to do as many examples or questions as you possibly can. It will eventually click into place, I promise.